Hello, everyone, again, and welcome back to the Advanced Valuation Technicals. I'm Raymond Boltron, and we're in the learning objective number two. Oops. Uh, all right, and what we're gonna learn is we're gonna transform the accounting statements like the income statement to note plat, balance sheet to invested capital, calculate the return on invested capital, find the free cash flow, and learn about how to adjust below the line, uh, or the value of operating assets, or what you call enterprise value. All right, let's start. So, why do we transform the statements? What the accountants give us as financial analysts are not or does not reflect the economic performance. It only reflects the accounting performance. And so, what we need to do is to transform the income statement and balance sheet into uh, operating, non-operating, and sources of financing. And so we're gonna look at how we transform those in a bit. But if you wanna forecast in the future, you always want to begin to analyze the history, the historical performance. And so we're gonna look at how to do that, and then and go from there. All right, transforming income statement to NOPLAT. What is NOPLAT? It's the total after-tax operating income generated by invested capital that is available to claim holders. It's basically your income, operating income, and it's available to all your debt holders or equity holders or preferred shareholders. Well, what is invested capital? Is the total capital required to fund core operations independent of how capital is financed. So this is the part where you would see the hard assets or the fixed assets like PPE, ROU assets, right of use assets, and intangibles, and other items in there. And the networking operating capital is also in there. So what our job is to separate the non-operating and operating part of the business. Why are we transforming these statements? So we can see the operating side of the business and we can see the economic performance of those assets. Well, what we usually learn from school is this formula right here. NOPLAT or NOPAT is basically the same thing, but usually they represent it by EBIT times 1 minus taxes. And usually EBIT contains non-operating um, income or expenses in there. For example, like restructuring charges, it might be in there. So it's not really representative of the recurring business. If you just blindly use this number, of course you can separate it. But well, how about the taxes? The tax that you use might be the effective tax or maybe the marginal tax, but it might not incorporate the effects of those items that weren't part of the operating part of the business. So it might skew this number in a bit. And you could see this later in a few details. And then what we're trying to do really is to simplify it, to make it a little bit more simpler, like EMC squared by Einstein's equation. Um, of course, you have your non-cash charges right here, which is your depreciation and amortization. And then you take out your capex or your fixed investments or hard assets investments, which you usually see, and then minus the investments on net working capital. What we're trying to do is just to combine these all and to make it more simpler but more comprehensive. You will see it later on because capex uh, might just show your capex on your PPE. It might not incorporate the capex that you use for intangibles or your ROU assets or the other long-term, operating assets that we need to incorporate. So what we're doing is incorporating everything, and we will see it later on when we get to a little bit more detail. So we're not using the quick and dirty way. We're using a simpler formula, but a more comprehensive way of doing things. So let's start with NOPLAT. What is NOPLAT? Net operating profits least or less adjusted taxes. So nowadays, it's the newer book took out the L of NOPLAT, and they call it NOPAT. It's basically the same thing. Uh, um, so it's basically taking the EBITDA, and it's basically the same thing with EBIT. The there represents the amortization on goodwill. A few years back, probably like 2000s, um, amortization goodwill can be tax uh, deductible or something like that. But now it's not. The accounting standards change, and so we don't really have to worry about the part of it. So EBIT or EBITDA is basically the same thing, minus adjusted taxes. So this would represent your 1 minus t, right, on your quick and dirty way formula. But this one includes more than just that 1 minus t. It includes well, we're gonna show it later on. We're just showing the formula right now, and then plus change in deferred taxes, and I'm gonna explain a little bit more on that later. So basically, your difference in EBITDA and NOPAT, which is if you move this to the right and then move all of this to the left, so this becomes positive minus. That would represent your cash paid uh, or cash taxes paid on EBITDA. So let's start with EBITDA. So operating revenues minus your normal cost. Each company are different or is different. So each line item might be different. These are just examples of those expenses. So your COGS, your SG&A, your depreciation, amortization, R&D expenses, or your other operating expenses. And that's the most normal expense that you would see. Um, why amortization, non-goodwill intangibles? And that's the up part, right? Um, so like I said before, goodwill was amortization. Goodwill was tax deductible, and it would be part of how you calculate the EBIT. But nowadays, they changed the um, accounting standards, so we don't have to worry about it. So amortization of non-goodwill. What do you mean by non-goodwill? It's your normal intangibles, like copyright. Um, when you buy a company, for example, when Microsoft bought LinkedIn, they might record it as intangibles. All right, and then you get your implied interest on operating leases. So let me explain this a little bit. So back in 2018, and it might be you might see it on the 10K 2018 or 2019, depending on their fiscal year end. We have this new standard called ASC 842 or IFRS 16. Some reason I can't remember 842. I can always remember 16. Um, um, it's so basically before the operating leases. Um, was was not recorded as an asset or a debt in the balance sheet, and the expense on those operating lease is recorded basically as rent expense on the income statement. But after this rule, they recorded the operating leases, as ROU, right of use assets, and right of use liabilities on the debt and assets. And how that changed is, it increased the leverage ratios, or it changes it a little bit, um, especially the profitability, return on assets, those kinds of ratios that you use assets or debt as a denominator. Um, that's one of the effects. And instead of rent expense, now there's two parts of it. You see an interest on operating leases. The other part is depreciation. So before it's just rent expense, now it's interest and depreciation on ROU assets. To be comparable, to compare the performance uh, back before 2018, where you only have rent expense, we have to calculate the interest for that, because we're not in a business in lending money, right? Why is it an interest? Because the debt portion of the ROU asset is basically treated like notes payable or a debt, um, which you pay interest on, but interest is not part of your operating, right? Because you're not in a business and making money out of investments or lending money. So it should be treated as an interest expense. So now, before 2018, you only see rent expense, which is maybe buried in cost of goods sold. And so we need to add back the effect of the interest expense, because that's non-operating, like I said. And usually we just uh, assume a risk, a cost of that for it, or most of the time the company discloses the the cost of those leases, and then you just take the beginning present value of those operating leases. So that's how you add this back, so that it would be comparable before 2018 and after 2018, and then you get your EBITDA. Hopefully that explanation clears this part. All right. So what does EBITDA excludes? What are the activities or line items that we're probably not in the business of, you know, uh, if we're a laundry machine or laundry business, we're not in the business of making money from interest or debt. We're not we're not in the business of lending out money or borrowing money. You exclude the goodwill amortization, you gain loss and discontinued in operation. These are just examples. Each company are different and it might have different examples, but I'm gonna mention some are that are very common. The most common probably investment income or interest income. These two are probably the most common. And then perhaps when you have discontinued operations. So these are the items that you don't want to include to EBITDA. And then these are the items that should include to EBITDA. Your operating part. This is the non-operating part. All right, adjusted taxes. So like I explained a little bit earlier, what we're trying to do with the taxes, you take the income tax provision, and then we're gonna exclude the tax shields associated with, say, financing costs, because it lowers our EBT, and it skews our taxes on uh, the activities that we're not really in the business with, and we're gonna see it in a bit. All right, so we start with the income tax provision, which we see on the income statement. And it's positive, it's an expense. If it's negative, for some reason, you would see it as negative. It's just a sign problem. But for example, interest expense. So we established that interest expense is not part of our business, right? We're not in a business of borrowing money. And so what happens is, if we have the interest expense, is it lowers our earnings before taxes, or our EBT. And what happens is it lowers our taxes because you have lower income. And so what we need to do to take off the effect of that interest expense, the effect of the taxes of the interest expense, is to adjust more. So we're adding it back to our income tax provision because we could have had higher income without it. And so that's why you see a plus on interest expense and a minus on interest income and non-operating income and non-operating losses. So everything that we excluded on EBITDA should be adjusted here on the adjusted tax. You should be used to adjust our taxes. All right, deferred taxes. Why do we take the change in deferred taxes? Well, first of all, we have two different tax books. Let me try to. Oh, I thought I have a different slide for it. But we have two different tax books: the books that we submit to the IRS and the books that we actually show to our investors, or the 10K, right? So the difference, the temporary difference between the two, is recorded on the deferred taxes. It could be a liability, it could be an asset, depending on, for example, all right, Apple bought this big equipment that costs, let's just say, 100 million. And to save money on taxes, they want to depreciate it faster versus a straight line depreciation. And so they get the tax benefit earlier, and perhaps pay the taxes later on. And so the difference between those taxes that you actually paid, or you have to pay, is in the deferred taxes. And where do you find those? It's in the balance sheet, right? It could be on the current and non-current, and it could be on the asset as well. Could be a current asset or a non-current asset. So what we need to do is trying to get the net liability. So you take the net liability this year minus the last year, and that basically represent how much we save or didn't pay as cash on the taxes. Remember that what we have on the 10K is not how much we paid as taxes. Um, Cash paid as taxes to the IRS. And so this captures that difference. So, for example, if the resulting number is an positive, then there's an increase in net liability, and if it's negative, the change is negative, then there's an increase in net asset. You always want to show it as net liability. And also, it may appear as current and non-current. So you always want to check the balance sheet fully. And sometimes it's actually embedded in the other assets. So you always want to check the other what the components are, whether those are operating or not. Is there a significant material line item over there that changed suddenly? All right, to recollect how to calculate NOPAT is to take the EBITDA minus the adjusted taxes or your taxes, right? And plus your deferred taxes. So if you combine the two, take the difference between EBITDA and NOPLAT, that represents the cash taxes paid on EBITDA. All right, let's start with invested capital. Invested capital. So, what is invested capital? That represents the operating assets minus operating liabilities. So, like I said earlier, it includes the operating working capital, your net PPE, your ROU assets, your intangibles, which is part of this, um, and maybe other, you know, a line called other asset might be here if you consider it operating, and then other long-term operating liabilities. So what is net operating working capital? It's the operating current assets, which are non-interest bearing, minus the operating current liabilities. It's important to mention that it should be non-interest bearing because why? We're not in the business of making interest. For example, the laundry business is not making money out of the interest because you're not borrowing money, you're not lending out money, and so we're gonna exclude those. Um, so it includes normal cash, and I'm gonna explain it a little bit more later. Accounts receivable, inventory, prepaid expenses. Notice that these are something that is needed to run the business, right? Your inventory, other operating current assets. It excludes excess cash, marketable securities. And why do we exclude marketable securities? Because that's interest bearing, that you make money out of investing, because we're not in the business in making short-term investments. We're in the business of making money out of laundry, right? So for example, okay, normal cash. So what is normal cash? That's the cash that you need to run the business. For example, your laundry business, right? You have a bunch of coins that you need to run so that people can get changes from their bills. So, most of the time, if I go to the laundry, I don't have a bunch of quarters. And so you put a $20 in, there's always coins in there. Because if there's no coins available, then nobody would probably use the laundry because nobody usually don't have a lot of quarters on their hand because they're heavy, they're dirty, of course. So normally it's 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 industry specific, but normally it's around zero point 0.5, a small part of your sales that you need to run the business. So you want to include it because you need it. Uh, However, the difference between the cash on the balance sheet minus the normal cash that you need to run the business is the excess cash. That thing, it just sits there. It doesn't do anything. So you want to exclude it because it doesn't. It's not part of the operating in operating your business. Operating liabilities, that includes accounts payable, accrued expenses. These are the things that we're in the business in you're paying taxes, you're paying dividends, um, and then you exclude the non-interest bearing or the interest bearing part of your business, which is the notes payable, the current portion of your long-term debt, deferred taxes payable, which we included this earlier in the calculation of no plat or no pat. How about other long-term assets? Well, what do we include? Well, oops, it's the intangible assets, the ROU assets, and the other assets. How about goodwill? Why don't we include goodwill? Isn't that a significant portion of doing business? Well, not. For example, if let's say my friend has a computer, he bought it for let's just say 2 grand, and now I'm in need of computer. I'm very desperate to get one because I have a homework, for example, for tomorrow, and I need a computer. And so I want to pay my friend twice as much. For example, let's just say 5,000 for that computer. Well, I gave him that 5,000, even though he only paid $2,000, and the difference is actually um, incorporated in that goodwill. The how much I paid for minus the fair value of those assets that you just bought, and that would be recorded as goodwill. Well, that's just imagination, right? It's not really representative value. It's not value at all. It's just you paid extra, and so we're not including it in the calculation of our operating asset. Well, deferred tax asset we already calculated in part for the NOPLAT. Underfunded pensions. Uh, what we do with this is because we're not in the business of making pensions or investing in pension funds, your pension company's pension fund, we're gonna adjust it later on. So we're gonna use these actually to adjust, except for goodwill, of course, because it's just an imagination. Um, we're gonna use this to adjust the EV later on. And minority interest, assets from discontinued operations. Those are just the example. Each company are different again, and you might not see all of this, or maybe there's a different line item that it's called differently. So just make sure, know that it's other. It has to be if you exclude uh, a line item when it's um, interest bearing. So you only include non interest bearing or what is necessary to run your business. So other long-term operating liabilities, you have your warranty liabilities. Of course, you need it when you sell a laptop. It comes with a warranty for like a year or two. When something breaks, you have to provide that warranty. It's part of running your computer business. Deferred revenue, other liabilities, if non-interest bearing. Um, Next is net PPE. It's easy. You can just find it on the balance sheet. It's normally the net amount, gross minus accumulated depreciation. So I'm not going to talk a lot more about that. That's obvious. So just to recollect, invested capital is network operating working capital plus your net PPE or your net intangibles, ROU assets, which is supposed to be part of this, and then minus your other long-term liabilities. Just to make a note, it excludes the ROU liabilities. So why are we excluding ROU liabilities but are actually including ROU assets starting 2018? Well, your ROU liabilities is considered as debt. So let's say you're buying a car, you do use a car, you use it as part of your business. but the financing of that car is actually that, and you don't, you're not in the business of making that, so you're not, and we're excluding the non bearing part of it, and decrease it below the line. So we're not including the ROU liabilities. So now you have the free cash flow. Um, right? Because uh, the formula is no plat minus the change in invested capital. You have both. You just take the difference, and then you get the free cash flow. And what you need to do is like your annuity formula and a perpetuity formula at the last stage or the terminal. Um, so what you do is you discount it to today, depending on how many years the cash flow is. So so how do we calculate the perpetuity? It looks complicated right here. So sometimes you call it perpetuity, continuing, terminal value. All means the same thing. So you take your NOPLAT, you multiply by 1 minus G, divide by ROC, divide by WACC minus G. Um, well, let's take a look at the denominator. We can probably know WACC minus G is basically R minus G. Um, uh, Earlier example, we only have the cost, uh, the required rate of return, which is basically the WACC. Uh, we actually get this from the Gordon growth model, which I'm going to show later on. So it's actually from the Gordon growth model, which is the dividend today times 1 plus G, basically your dividend next year, right there, divided by your cost of equity minus growth, because it's to perpetuity and we're assuming that it will grow at a stable rate. And so, what is D1? Can we expand it? Yeah, of course. It's basically earnings times your dividend payout ratio, right? So if you're giving back 50% of your earnings, that would represent, if you multiply both 50% times your earnings, then that would be dividends. Well, what is DPR? It's basically the same thing as 1 minus RR, or your retention ratio, right? So basically DPR minus retention or plus retention ratio is equal to 1. Uh, this is basically equal to each other. So earnings times your 1 minus retention ratio or your dividend payout ratio, which becomes your dividend 1 divided by R cost of equity minus G. Well, what is this retention ratio really? How do we change it from this to this? So there's actually a formula to calculate your sustainable growth. And how to do it is to take your return on equity times your retention ratio. So return on equity, that represents the return on your equity, right? And how much you keep out of those return is what your growth is, right? Because you give out those, a part of it, a part of this is given out, and that one will not grow. What you keep is what you use to reinvest in the business, and that's what we call G. So if you just take this off, divide all sides by ROE, you get G divided by ROE. And so you just replace retention ratio right here to G divided by ROE, and you get this formula right here. Looks familiar, doesn't it? So if you just replace this earnings or your net income to NOPLAT, right? And we're changing this because this is available to all the shareholder of the company or stakeholder of the companies. Sorry, includes your debt holders, your preferred holders, if there's any, and equity holders. We use the WACC minus G, and 1 minus G and ROIC, or return on invested capital. So that's how we calculated the terminal value. And of course, once you get the terminal value, since this is in T1, it'll be on T0 on the last term. So you divide it, for example, this is this right here, and T plus 1 would be 3 plus 1 be 4, and the value would be on the third year. And so you divide it by this to discount it to today. So that's what you're going to do. All right, so we talked about the terminal rate, terminal formula, terminal value formula right there. To recollect, we talked about how to transform the income statement to NOPLAT, balance sheet to invested capital, basically changing from accounting performance to economic performance, and how to calculate free cash flow is basically taking the difference between NOPLAT and the change in invested capital, which reflects your non-cash charges, your change in fixed income investment, or I'm sorry, fixed assets investments, or capex, and net operating working capital, change in net working capital. And then you have your multiple cash flows per year, and how to calculate the terminal value using a perpetuity formula derived from a Gordon growth model. And you discount it today, you get your value of your operating asset. And now we're right here. So you have the V, or you're basically an enterprise value, or the value of operating asset. And what's next is to add those adjustments to get to the equity value. This value right here doesn't represent the value of your equity, right? Because this represents all the claims of the equity holders, your preferred shareholders, and your debt holders, and etc., right? So we're going to adjust this number to isolate what should we have after that. So below EV adjustments, we see this formula again. You add the non-operating assets minus the debt minus the preferred minus other, and we're gonna look at each of one of it. And I basically explained this earlier. Equity holds the residual claim on firm's assets after the debt holders, after the preferred shareholders, and other stuff. So, what does value of non-operating assets mean? What does it include? Well, you got your excess cash, right? A part of your cash, remember, around 0.5% to 2%, perhaps, is needed to run your business, your normal cash, or your cash on a balance sheet minus your normal cash would be your excess cash, which is right here. Your marketable securities we did not include to calculate invested capital because they're interest bearing. Your other stuff that we did not include. So that's commonly used non-operating assets. And the next one is your debt, right? It's easy to find the debt. It's just take the market value of debt or the book value, which is probably close to your market value. Book value is close to your market value, although it changes every day, of course. And then your preferred shares, which normally don't see anymore. Um, Maybe for private companies or maybe a newer company, but older companies tend to have, or maybe depends. Commonly, we just see common shares, and then the value of other. Well, this is right here ROU liabilities. We're deducting it because it is considered as debt, right? So that your underfunded retirement obligations. The companies still have to pay for the unfunded part of that retirement. Your employee stock options that will probably um, be exercisable or be exercised in the next few years. So you want to incorporate it because that would be basically a debt, right? Because the company has to pay for that. Minority interest liabilities, same way with minority assets as well. A good analyst is actually pretty, is defined by its ability to find these other adjustments because they're really hard. One of the harder ones are lawsuits. You gotta read the 10K and make a judgment whether those losses are probable, or sometimes they already incorporate it in the liabilities, but some aren't incorporated, especially if it's not probable. So sometimes I would put 50% of the likely, or they have a word for it. I don't remember top of my head, but some lawsuits are not incorporated in the balance sheet. Therefore, they're off balance sheet. You have to incorporate it. All right, just to review, we have transformed the accounting statements to economic statements. We know how to calculate free cash flow, and we calculate the value of operating assets and adjusted below the line, and we get the value of equity. And then what you do with the value of equity, you divide it by the number of shares, and you get your stock price. All right, we're done with learning objective number 2. We're gonna go with learning objective 3. Did I learn? And we're gonna go through an example, a couple of examples. All right, see you in the next video.